Welcome back. Cautious trading this morning ahead of the Federal Reserve's hike decision this afternoon. We are waiting on a 75 basis point hike. Yesterday, I spoke with former Kansas City Federal Reserve President Thomas Hoenig on what he's expecting out of today's meeting. Watch.
I am expecting a 75 basis point hike. I don't think the Fed has an end point in mind because they don't know where inflation is going from here. But there's still a lot of liquidity in the market. You can see that with the merger announcements. You can see it in terms of the market's expectations, ability to move the market up. So there's a lot yet to be done, I suspect, in terms of addressing inflation and interest rates.
Joining me right now is Federated Hermes Chief Investment Officer of Equities, Stephen Auth. Stephen, it's great to see you this morning. Thanks very much for being here. I want to get your take on Jay Powell's comments, what you're expecting after we get the 75 basis point hike, and also get your take on the balance sheet runoff. What are you expecting?
Probably more of the same, Maria. Maybe he tries to go down a guide towards 50 in December. That's what the market expects. I think the key difference is that the consensus is kind of keep talking about a pivot. And I think he just is going to have to, and he is going to insist that no pivot is coming. I mean, he may pause, he may slow, but the idea that he's going to start cutting sometime in 23, which I think somehow in this bullish run we've had in the markets is probably unlikely to hold. He's going to really, my guess, is emphasize his steady hand at keeping rates high until he sees these inflation numbers come down, or he creates an economic crisis. But he has yet to see the financial system crack, so he's moving along.
Well, I mean, moving along, also taking this economy down and slowing it down. A lot of dire predictions for 2023. But I want to get your take on something Thomas Hoenig said to me yesterday, the former president of the Kansas City Federal Reserve. He was really focused on the balance sheet runoff, and he said that with the Federal Reserve's plans to shrink the balance sheet by taking out $95 billion a month, that is going to take $1 trillion of reserves and other liabilities out of the system for a year. The Fed is not only ending, in effect, the purchase of new government debt that comes with our deficits, but it will no longer renew the debt it already holds. That's the runoff. The private sector or foreign buyers must purchase that new debt, plus the portion of the debt that the Fed is letting run off. He says all of this is going to be a vacuum, sucking out the liquidity in this market, and it's going to be a tough period of adjustment. What are you expecting from the market?
We're calling it a rocky landing, Maria. That's been our code phrase for the last 6 months or so. I think next year, that's another area where we're really kind of off the consensus here. We just have a rocky landing at best. We took our economic numbers down next year to sub-zero all 4 quarters, minus 0.4%. So not a complete meltdown, but certainly a very difficult economy. We've got earnings at 200 for next year. The consensus is still, even through this earnings season, is only dropped earnings down about $10 to about 238 for next year. But we think earnings are going to come in substantially lower. So we're recommending, stay on defense here. Yeah,
I mean, look, nearly 2/3 of the S&P 500 companies have reported their quarterly earnings so far. Adam Johnson, jump in here with your take on what you've heard from these earnings.
Well, if you look at the earnings, Maria, and you take energy out, they've actually dropped about 5%. You put energy back in, and earnings are up 5%. Stephen, my question to you, in an environment like that where energy is such an outsized contributor to the earnings, what do you like?
We like dividend-paying stocks, defense. We like energy. We like the industrials, like financials. We like consumer staples, utilities, companies that are paying, 3 to 4% dividends with some dividend growth, perhaps just nominal growth, given what's going on in inflation. But at least it's a growing income stream. We think that the next 3 to 4 years in the market's going to be difficult. Probably a return pattern of maybe 5 to 7%, not the 15 to 20 people have been accustomed to. So we're staying in defense here. We think that'll be enough to produce a decent return in the market, but not off these levels. I think the market's probably got to go lower before it stabilizes.
Yeah, and we've seen this demand destruction, right? Look at housing. We've got this story. Americans are souring on home ownership. Just 1 in 5 say that they could easily buy a home. Most say property is overpriced and it's gotten too expensive, with mortgage rates around 7%, Stephen, real quick.
Yeah, affordability ratios have collapsed, and so housing markets are really the first part that's really taking it on the chin, Maria. We'll see how the rest of the economy does into next year.
All right, Stephen, it's good to see you. Thanks so much.
Likewise.